Good evening, students. I am Dr. S Jeyaraman, Associate Professor, Department of Management Studies. Today, we are going to discuss about fundamental analysis in the security analysis and portfolio management subject. Yesterday, we stopped with the discussion of what is investment process. Yesterday, we discussed a lot about how to create the investments. What are the steps there in it? All these things we discussed. But among these topics, two important topics we discussed a lot, which are all having two important validness among the entire process. Among the entire process, it starts with the setting up of the investment policy, analyzing the environment or analyzing the overall company's economy, whatever it may be. Then again, valuation of the equities as well as the real worthiness of the companies. Then we are constructing the portfolio, finally evaluating the portfolio after its performance. All these things we discussed in yesterday's class. But among these topics or among this process, which are all considered as most important? Because based on those steps only, the entire investment is going to give the returns. Based on the returns only, we are going to keep our investment, because everybody is making the investment for the purpose of maximizing their returns. You have to see, among the entire investment process, the analysis and the valuation getting its validness. Without these two steps, the entire investment process will not get worthy. Why means, the analyzing of securities as well as the environment plus valuation, that means identifying the intrinsic valueness or the real worthiness of the equity shares, going to give the returns of the investment. And you have to see, the quantum returns of any investment depends always on analysis as well as valuation of the investments. Okay, sir, how we can do this? How we can analyze, how we can valuation? For that purpose, there are some steps and techniques are there. Today we are going to discuss in an elaborate manner. How to analyze and evaluate the investment opportunities? You have to see, there are two different approaches are there in analyzing and evaluating the investments. They are called as fundamental analysis and another one is technical analysis. What these things are? They are the basic two school approaches in investment management. Based on these approaches only, we can able to evaluate, we can able to analyze. By the way of analyzing with these methods, we may identify the real worthiness of our investment. The real worthiness helps to identify which environment or which investment, which industry or which company is flourishing, where we have to make our investment. By the way of making the investment, shall we maximize our returns or not? So these things are possible with this kind of things. So you have to say, the fundamental analysis and technical analysis are the two schools of financial market, and fundamental analysis trying to identify the real value or true value based on its expectations. But technical analysis, which is analyzing the investment or equities based on its past performance. Okay, sir, you said there are two different methods are available in analyzing and evaluating the investments. What is the difference in between those methods that we have to identify that? I told there are two different schools of evaluating the equities or investments, the fundamental and as well as technical. Is there any differences? Certainly some differences are there. They are the fundamental analysis trying to evaluate the securities by the way of attempting its intrinsic value, by the way of identifying its intrinsic value based on its past performance. The performance is always measured in terms of financial statements, financial performance, what is the company's strength, what is the management strength in all the dimensions which is analyzing. But the technical analysis, evaluating the securities based on its price value movement, what is the price it's reached over a period, how much number of securities sold in the market, like such it is taken into consideration. So these two things are entirely different schools of analysis. I am analyzing the performance of the company, I am analyzing the performance of the industry, I am analyzing the performance of the environment, and what happened? whether the company created the profit or not. If I am analyzing like such, that is called as fundamental analysis. I am taking the consideration of price alone, what happened to the price, what is the movement of the price in the previous year, by the way of having those records with me, by the way of applying in the charts or any other technical tools. If I am evaluating, that is called as technical analysis. So this is the major difference in between the fundamental analysis as well as the technical analysis. You have to see, the technical analysis do not attempt to measure the security's intrinsic value. Instead of, it is trying to identify the patterns and trends of the price movement. Patterns and trends of the price movement. So this is the major difference in between the fundamental analysis as well as the securities analysis. Okay, sir. Sir, you said for evaluating the investment, there are two methods are there. Any number of investors are there in the market. They will adopt any method. Among these two methods, they will adopt any one. For example, if I am going for fundamental analysis, why I have to stick on the fundamental analysis? Otherwise, why I have to stick on the technical analysis? Today we are going to discuss only about the fundamental analysis. So in that case, why I have to stick on fundamental analysis, that I have to know that. Why fundamental analysis is to be considered for evaluating the equities or investments. Because the fundamental analysis gives the answers for the following things. You have to see, in fundamental analysis I told, which is trying to determine the real worthiness or intrinsic value of any equities or any investments. How I can able to determine the intrinsic value of any investment? The intrinsic value of any investment is possible by determining the following things or identifying the following things. They are the potential riskiness of any company or the returns of any company, how much they are able to earn, what is the expected return, what has happened in the previous, and how they are moving with the industry. You have to see the potential riskiness of the firm linked with the prosperous of the industry. Usually the companies, the group of companies, they are called as industry. A individual company's development always depends upon the industry. The industry is called as, a group of companies are called as industry, and the industry will develop depends upon its environment, means the economic environment. You have to see the prosperous of the industry always based on prosperous of various industry. Economy is a combination of various industry. So if the economy grows, automatically the industry will develop. If the industry develops, automatically the companies also will flourish. These kind of things where we can able to analyze or where we can able to evaluate. Only with the help of fundamental analysis we can able to evaluate all these kind of things. You have to see the various industries will influence with the development of macroeconomy. So overall economical development will be there, then only we can able to identify whether the industry is growing, whether the company is growing or not. So all these things are linked. By the way of identifying each and everything's link and development, that is possible only there in fundamental analysis. That's why we are saying you have to use the fundamental analysis to evaluate. Okay, sir. What is fundamental analysis? Now we have to come for the exact what it is. We have to say, the fundamental analysis which is concerned with determining the intrinsic value. Many times I have repeated that. Real worthiness, which is trying to determine the real worthiness of any investment, especially equity shares. How this equity shares intrinsic value is so helpful. For example, I am going to market for buying a product. For example, television, you have to consider like such. The cost of the television in the market is 12,000 rupees. But a new company is coming into the business. What they are saying, we are ready to sell the same product for 10,000 rupees. Whether it will be profitable for buying the same product means certainly it will be the profitable. What is the real worthiness that we have to identify? If the real worthiness is 12,000 and the company is selling for 12,000 rupees, there is no change in the price. It is not a profit to the investor. But the real worthiness of the product is 12,000 and which is sold for 10,000. In that case, which will be a profitable? The investor willingly buy the product, or the person who is willingly buy the product. For such kind of thing, we need fundamental analysis. The fundamental analysis gives the real worthiness. Based on the real worthiness, we can able to make a comparison with the market price of any investment. When we are discussing about the market price of the investment, what is there and what is the real worthiness, we have to make a comparison. When the market price is higher than the real worthiness, in that case, whether it is advisable or not to advisable. If the real worthiness is higher than the market price, in that case, whether it is advisable to invest or not to invest. If the real worthiness is always higher and the market price is lesser, in that case, it is advised to invest in that kind of equity shares or in the investment, because we are going to get back a lot comparing than giving it. If the market price is more and the real worthiness is less, in that case, which is a hyped investment, which is not advisable to invest. So such kind of possible investment decisions is available with the fundamental analysis. You have to see the intrinsic value, which gives the idea about whether the price of the stock is undervalued or overvalued. And we are making a comparison with the current market price. If the script is undervalued and it is less than the real worthiness, the investors willingly invest in it. The real worthiness is higher and the market price is lesser, in that case, the investor will make it invest in it. Until otherwise, he will not. Okay, these things we have to identify. For that purpose, the fundamental analysis is so helpful. Okay. And you have to say how I can fix the real intrinsic value, real worthiness or intrinsic value. The intrinsic value is possible by the way of evaluating the information contained in financial statements, industry reports and economic factors. By the way of analyzing the economic factors, that means macroeconomic factors. For example, entire environment of the world. What is the overall GDP of the world? What is the GDP of India? What is the GDP of Tamil Nadu? Like such, the macroeconomic factors that has to be taken into consideration. After that, in which industry we want to invest, that industrial's development, performance, profile, everything is taken into consideration. Plus, which industry we are going to invest or which company we are going to invest. Their financial performance, all these things are taken into consideration. By the way of analyzing over a period of time what happened with the particular company, whether they are showing the performance, whether they are showing the development. If they are developed and they are showing the performance, certainly the company is preferable for making investment. And by the way of identifying these kind of things, easily we may identify the real worthiness of the investment. And you have to see, and the health of the business and future prospectus. Health of the business and future prospectus always depends upon their research and development and some internal matters also. How they are utilizing the funds, how they are utilizing the resources, all these things are there. Then after, understanding the company's comparative advantages and competitors. Even though the company is performing more, if the competitor they are giving the innovative product comparatively superior than this company's products, they will outbeat them. So automatically we have to discuss those kind of things also. By the way of discussing these kind of factors, by the way of analyzing these kind of factors, easily we may identify the real intrinsic value of the firm. So the fundamental analysis is trying to identify the real worthiness of any firm or any securities by the way of analyzing all these factors. How it is going to be analyzed or what we have to do regarding the analysis, we will discuss this. And before getting into this, I want to share information with you. In a recent study, especially it has happened in 2013 regarding the securities market, world over securities market. What they found, near around 30 to 35% of the values of equities or any investment affected by the economic wide factors. I can say it to you. Very recently, the Tamil Nadu government, they made a lot of changes in the levies regarding or the charges regarding the real estate. They increased the value or government value for the particular lands, and the changes are there in the registration. Registration fees increased. What happened? Because of huge incremental in the registration fee, the entire real estate come down in Tamil Nadu itself. Even in today's paper, you may identify 25% of the registrations come down because of the incremental in the registration fee itself. This factor is considered as macroeconomic factor. Because of the macroeconomic factor, the development of the particular business got affected. I'm making it an example to you, and you have to see the economic weight factors which is affecting near around 30 to 35% of the real worthiness of any company or any equity shares. And industry weight factors, the industry's prosperous or the industry's development is also affecting the price of the equities. So the industry weight factors affecting near around 20% of the equity values. Then company weight factors, the personal factors of the company, their performance, financial performance, management, their vision, their future prospectus, all these things are taken into consideration. These things are also determining the value. So near around you have to see 80 to 90% of the equity share value or investment value is getting affected because of these three factors only. Remaining 10% we are not able to control. These other factors are there because of various factors, because of war, because of drought, because of tsunami, like such kind of natural calamities. Something may happen there. So those things we are not able to stop it. But these factors we may predict what is happening. By the way of identifying, we may stop the loss with our investment. Okay. You have to say what is fundamental analysis and what is happening in fundamental analysis. The fundamental analysis, which is consisted of three important steps, sir. There we are analyzing three important factors. They are economic factors or economy analysis, industry analysis, and company-wide analysis. Three different analyses we are executing for identifying a single security or single investment's real worthiness. You have to say economy, industry, and company constitute the main activity in the fundamental approach. By the way of analyzing these three factors, the fundamental analysis trying to identify the real worthiness of any company. Okay, sir, how it is doing the analysis? Normally, the fundamental analysis having two approaches in evaluating or in analyzing the factors, opposite factors. Two factors are there. They are top-down approach or bottom-up approach. What is that, sir? Top-down approach. It's like a waterfall model, how the waterfall jumps from the high one to the lower place. It starts with the macroeconomy because everything constitutes in the macroeconomy, nation, state, industry, whatever it may be, it all belongs to the macroeconomy. So it starts with the macroeconomy. Then it shrinks or it limits itself to the industry, particular industry. Then from the particular industry it limits to the company level. This is one kind of approach. You have to see, it starts with the economic analysis, then it comes down to industry analysis, then it shrinks to the company level analysis. Then what is happening in the bottom up approach? First it starts with the company, then it comes down to industry, finally which is analyzing about the economy. Once I decided in this company only I want to make my investment means, first I will do the analysis about the company. Then I will analyze about what is the flourishness or prosperity of the particular industry. Then I will think about the economy. So these are the ways the fundamental analysis is making the evaluation, trying to identify the real intrinsic value of any investments. And you have to see the top-down approach, which starts with the global economy, then narrows to the regional level. In the bottom approach, which starts with the company level, then it goes up to the macroeconomy in such manner which is happening. Okay. What are the evaluation methods are there in the fundamental analysis? Because you are saying the fundamental analysis is trying to identify the real worthiness of any investment. How it is happening? What are the things are there? The fundamental analysis, which is having three evaluation methods with itself. They are economic analysis, industry analysis, and company analysis. These three steps will give the real worthiness, or which will give the idea about where we have to make our investment, how much we have to make our investment, how long we have to keep our investment. Such kind of ideas possible with these three different analyses. Step by step we will discuss what are the things are there in the analysis, how we have to do this analysis. So first we are going to discuss about economic analysis. What is economic analysis? What are the factors to be considered in the economic analysis? How we have to execute it? What are the factors to be taken into consideration? These all these things we will discuss here. You have to see economic analysis Economic analysis is nothing but analyzing the economic environment of the particular investment. For example, if I want to do my investment in India, means in the entire India is considered as economic environment for myself. Otherwise, if I want to make my investment in Dindikal, Tamil Nadu is a economic environment for myself. So I have to analyze in that kind of category. Here economic environment means you should not consider the microeconomic aspect, such is related very particular to the particular one or very specific to the individuals or very specific to the particular company, not like such, which is a macroeconomic environment. It includes various factors, including politics, including gross domestic product, including the tax policies, including various factors, whatever the things controlling the entire environment. We have to say the economic activity is determining whether the company is prosperous and sick. How the economic activity determines the company's activities and prosperous and sick? You have to see, because of American bank crisis, the entire software industry facing still problem, especially Indian software industry facing the problem. What happened with the American banking companies? They gave the loan regarding the housing loans to the people, those who are in America, without properly evaluating. They lend a lot. What happened finally? Because of these kind of crises, many of the American banks, they shut down. Because of the American banks closure, the service rendered by the Indian software companies, they lost their business with the banks. Because of the loss of the business, Indian software companies, they have to cut down their employees level. They made a retrenchment. They made a golden handshake. It affected the Indian software industry. So somewhere in America, yes, collapse is there. How it is affecting the Indian environment? Because all the entire environment, economic environment is related. Even you have to identify, if anything happens in Europe, immediately we can able to identify the changes in our stock exchange. If anything happens in Middle East or if anything happens in the Japan, immediately we can able to identify the changes there with our stock exchanges. Because this macroeconomic environment is related each and every area, because in the entire globe is connected with various categories by the way of raw materials, by the way of labors. So in such case, the macroeconomic environment determining the company's prosperous and sick. Okay, sir. When the economic grows, automatically the industry will grow. If the industry grows, automatically the company will grow. So it depends upon the company's development, always depends upon the economy. If the economy is not good, automatically what will happen? The company's development will stop. You have to see, when it slows down, it affects the sales and the profit of the business. Okay, sir, how I can evaluate the economic environment? I can evaluate the economic environment with the various tools or various factors to be considered. What are the factors I have to be considered? We have to see near around 12 factors are there in it. By the way of analyzing these factors, easily we can able to evaluate the economic environment of any nation or any country or any state. We have to say the first factor is gross domestic product. Savings and investment pattern of a particular nation or the environment, inflation and inflation rate available in the nation, interest rates, budget, tax structure, balance of payment, monsoon, infrastructure facilities and demographic factors of the nation. By the way of analyzing these factors, whether the economic environment is having the prosperity or development in the coming days, that easily we can able to identify. Whether the economic is in a recession stage, whether the economic is in a development stage, that easily we can able to identify that. We will discuss those points one by one. The first point that we have to discuss while evaluating the economic environment is gross domestic product. What is it, sir? Gross domestic product. Even you may identify the definition in the macroeconomics. Marshall told, whatever the products which is created with the help of available labors and resources within the particular nation in a particular year, whatever the products or services you produced, that is called as gross domestic production. This gross domestic production includes whatever the products we created, whatever the services we created, plus whatever the products and services we exported, minus whatever the products and services we imported. Okay, sir, by the way of identifying the GDP, what we can able to do is say how it will be indicator for making the investment. If the gross domestic product has to increase every year by year it has to get increase. By the way of continuous incremental in the GDP, what we can able to identify, the particular nation or the particular state is developing more because they are properly utilizing their resources. By the way of properly utilizing the resources, they are maximizing their output. By the way of maximizing the output, they are meeting out the demand of the people. Not only meeting out the demand of the people of the nation, they are exporting the products. So by the way of exporting the product, they are earning more. If an environment is earning more, the industries will earn more, the company will earn more, automatically profit will be more for the investors. So by the way of properly analyzing the GDP, the particular nation is producing more or not, that easily we can able to identify that. For that purpose, we have to evaluate the GDP, and you have to see the GDP indicates the growth rate of the economy, whether the economy is growing or not, which is possible by identifying the GDP's development. Year by year, how much GDP is growing, that we can able to identify that. And you have to see, in the year 2005, the entire India produced only 8,34,035 million US dollars worthable product, but which is increased in the year 2010 to 17,27,111 billion US dollars. You have to see what a dramatic development there with the nation, because only in the period India started its globalization. Over a period of time, n number of companies, they started off investing here. By the way of investment, lot of business got developed. So what happened? The people started off producing more. Automatically, the development is heavy there. Okay. You have to see, here I present a graph to you. This particular graph representing what is the GDP contribution by entire nations in the world. Actually, the total global GDP is taken into consideration. Among the global GDP, what is the overall contribution by each and every country? For example, biggest countries are there. US is there, Japan is there, China is there, Brazil is there. Everybody, they are trying to produce more. Every year they are trying to increase their GDP. So here I am presenting what is the contribution of these fellows in terms of billions of dollars. Why I made it to means, among the globe, who is doing more? Who is having the highest GDP? If a country is having highest GDP, means that is preferable for making the investment in the particular nation. Here you have to see United States, which is always residing in the topmost position. They are making in near around 14 crores, more than that. They are making in crores and crores of $1 billion. I am not able to make it like such. China is in second position, Japan is in third position, and greatest thing to us, India is in fourth position of overall GDP of the world. We are contributing the more comparing than any other nation. We are in the fourth position. So in that case, we may rise our. India is one of the good country. They are manufacturing more, which is the right environment for making the investment. And you have to see the one of the nation which is called as Israel. They are in a near around 22 or 25th position. So in such manner, by the way of analyzing the contribution to the overall global GDP, we may identify which are all the countries are developing, which are all the countries are contributing more, which are all the countries are producing more. If the countries are producing more, which is having the right opportunity of making investment, that conclusion we can able to make it. And you have to see, here I presented one more table. This particular table is based on World Economic Situation and Prospectus Forum. From the United Nations only I took this particular category. Here what is happening, we are classifying the entire world into region wise. How means Europe area, United States Asian area, and developing countries like such. Two different classification happen, that one is high income, another one is developing countries. How the GDP is happening, a 3-year comparison given there here, and you have to see overall development of the world is developing every year. In the year 2011, which is 2.8 only, in the year 2012, 2.6% of development in the GDP is there with the world. In the year 2013, 3.2% of GDP is increased. So comparing than the previous year, near around 0.6% development is there with the GDP. And you have to see, the development is always there with the nations like Brazil, Russia and China and India. And in the year 2011, India is having a GDP of 7.6%. But you have to see in the 2013, we got a development, 0.3% of development is there with the Indian GDP. But if you compare these things with the China, it was something little. You have to see with the China, in the year, actually they are decreasing. In the year 2011, they produce near around 9.3%. The growth rate is 9.3%, but it come down to 8.5 in the year. When we are comparing it to China, we can able to identify India is still growing. People are having enormous opportunities. So automatically, if anybody is coming across this particular data, they came to a conclusion, comparing to China, India is fruitful for making the investment. So automatically we can able to grasp the investment from across the world. And you have to see the Russia and Brazil. Russia and Brazil are somewhat stagnant comparing to these nations. China is declining, India is developing. So among the different economic zones, you may identify that India is developing and other remaining countries are stagnant or somewhat decreasing. In that case, India is a fruitful country for making the investment. Okay, once we selected the particular nation or once we selected the particular environment, then again we have to analyze about the environment. Among the globe, we discussed a lot. Among the regions, we discussed a lot. So among the globe and region, a particular nation is got selected for making investment means. In that case, we have to clearly analyze the economic development and GDP of the particular nation elaborately. So here you have to see, here I made a comparison of, please, here I made a comparison of Indian GDP for a year of 10 years, from 2004 onwards, 2014, I made a comparison of Indian GDP. You have to see, excuse me, in the year 2004, India's GDP is 7.92% only. But you have to say in the year 2010, which reaches up to 10.26%. So what a drastic development is there, from 7 which gone to 10%. Actually, the country is developing, the country is producing more, which is the right example for that. But what happened because of the global recession in the year 2011-12, we made a drastic dropout in the production. But even though the government steps and furthermore investment from the foreign nationals as well as the industries people take care, what happened? Again in the 2004 we started off developing. So in the year 2011 we produced only 4.7%. But what happened in the year 2014, which is increased to 5.63%. So what it shows, the Indian GDP is increasing, India is producing more, this particular economy is developing. That conclusion easily we can able to make. And you have to see, it is which is given in billions of dollars. You have to see in the year 2005, which is $721.6 billion only. But in the year 2014, you may identify that $1,876.8 billion we produced. But you can able to identify that again. In the year 2012 only we reached the maximum GDP level category. Growth rate is less in terms of money wise I am saying. So again we can able to make a conclusion. This particular economic environment is developing, which is right for making our investment. Okay. And again, here once we analyze the India's growth rate over a period of time, then again I am making the growth rate of India's GDP in various sectors. For example, industry sectors that can be classified into various groups like transport, like mining, like quarry, like electricity, banking, like such kind of things. So sector wise, how the development is there, that I am making an analysis again. You have to see, excuse me, In the year 2011 and 12, the overall development happening only with the industry. Comparing any other kind of category, you have to see the industry is developing a more 2.5%, 3.7%, 5.6%. But if you come across the electricity, gas and water supply industry, which is also developing, but comparing to 2011 and 12, in the year 2012 and 13, which is somewhat less. But constantly developing is infrastructure industry only. You have to see in the first quarter of 2011 and 12, they are able to make only 3.5% of the overall GDP. Then what happened? You have to see in the 2012 and 13, they made nearer than 10.9% of the contribution of the entire GDP. So which industry is flourishing in the particular economic environment? That is also possible by the way of analyzing the category. Okay. Okay. Once we discussed the once we discussed the entire nation's development, industry-wise development, then we have to analyze which part of the nation is also developing. That is also taken into consideration. See, in India, only 4 states, they are attracting more foreign direct investment. Do you know which are them? They are Maharashtra, Karnataka, Tamil Nadu and Madhya Pradesh. These are the 4 nations in size wise, not only in size wise, in the aspect of attracting the economics, in the aspect of attracting foreign direct investments also. These 4 states giving the backbone to the entire Indian national financial system. You have to see the contribution of these states in the nation. Karnataka, which is giving 6.9% of the overall GDP contribution, and you have to see Bihar is also developing in this particular region only. But consistently Maharashtra, you can able to identify 7% contribution is happening with them consistently. And you can able to identify that 7.2% with the Tamil Nadu, but this particular duration they dropped because of various political factors that we have to accept. And you have to see the consistent performance of Madhya Pradesh. In the last year, they made the 11% of the GDP contribution in the entire India. This year also they made a contribution of 10%. See what a drastic contribution they are making every year. By the way of saying this, where we have to put our investment, even you have to say, again I am recapping that. First we are analyzing the macroeconomic, world over analysis, which country is giving the contribution. Then again what is happening, region wise also we are discussing, which region is providing the high income group and low income group is also discussed. After that we selected a particular nation. Then we discussed the development of the particular nation. What is the GDP growth of over a period of time? A decade only we discussed. After that, what are the industries? How the industries development there in the particular nation? Then after, we are discussing in which state performing more. You can able to identify which states are performing more. So by the way of analyzing in which state we have to do, in which industry we have to do, easily it is possible to identify that. So by the way of analyzing the macroeconomy, in which industry, in which state we have to make our investment, easily possible there. Okay sir, how it is going to give the real worthiness, sir? If the development is there with the industry, it will reflect there in the particular company's performance. If the particular economy is developing, it will get reflected in the industry and it will be reflected in the company. That's why we are going to analyze the economic factor. By the way of analyzing the economic factor, the real development is there with the nation, the real development is there with the industry, the real development is there with the company, that we can able to make. Okay, that's by the way of analyzing these things, we can able to identify the real worthiness of the particular investment. Okay. While discussing the macroeconomic factors, already we discussed a thing about what is the GDP of the nation. The second factor that we have to analyze is the savings and investment pattern of the particular nation or particular environment. Sir, how it correlates the savings and investment pattern? Why we have to analyze regarding identifying the real worthiness of any equity share? If any nation has to get developed means they need some capital. How the capital can be formed? Which is not possible alone by the government. the people of the nation also have to make some contribution regarding the capital development of the nation. The capital can be formed by the way of the savings and investment of the people. Without savings and investment of the people, the capital formation is not there in any nation. We have to say the people, they will store or they will save some money for their future prosperous. That will be rendered to the industrial society, and the industrial society will use them for the production and development, and they will earn the profit, and a share will be given to the people again and again. It will be a rotation. By the way of the savings and investment pattern only, we can able to identify whether the particular nation will develop or not. How means, whatever the savings resides with the bank, whatever the savings resides with the financial institutions, whatever the savings there with the insurance or PF, whatever it may be, all these things are where it is going again and again. If the banks collecting the money from the people, if they are collecting the deposit from the people, it will be given to the industry in some other terms of loans or any other kind of thing. So the loans will be utilized for the development of the business, again it will be repaid to the bank, again it will be repaid to the public in terms of interest. We have to see how it is going to work, how it will be the supportive thing for the economic development. You have to see. In the year 1970s, India had a savings pattern of near 19.3% in its GDP. Whatever the overall production among them, near around 20% made as savings. And in the year 80s, which come to near around 22 or 23%. But what happened? Over a period of time, this savings and investment pattern will come down. The savings and investment pattern come down. Presently, India is able to produce more than crores and crores of money, but the savings are very less because of the globalization concepts, because of the spending mentality of the people, the savings come down. You have to see, in the year 2000, the total savings is only 2,474 or 2,475 billion rupees only. What a production we people are doing, near around 1,000 crores of production happening or 10,000 crores of production happening, but we are able to save only 2,475 crores only. And you have to see, and in the year 2012, we are having only 9,690 crores only we can able to make a savings. Is it advisable or is it a right thing? Means actually still our savings pattern is not enough to the particular nation. That's why we people are attracting foreign direct investments, foreign institutional investment to the particular nation. Here I gave a comparison how the savings and investment pattern is there, how the economic development happens. You can see this such. Here also I made a analysis of for a decade. In the year 2001 and 10, what happened? The overall changes in the particular year is 2,474 crores only. In the currency wise savings, which is 156, in the bank deposits near around 947 crores, in the non-banking deposits just only 30 crores, but you have to say in the shares they invested near around 111 crores only. And how it got developed, you have to say because of the globalization concepts. In the year 2010 and 2009, what happening, you have to see shares which has increased to 743 crores. In the initial year, we got only 111 crores, and here you have to see 743 crores. The people started off thinking about, if we invest in the equities, certainly we will get the good returns. Okay, what will be the benefit to the industry? If the people are starting investing in the equity shares, automatically the company will get the money for their development. They will not go for any banking companies, any financial institution, and they will take the capital or they will take the loan on interest. It is not necessary. Actually, if the people are invested in the equity shares, the money is available without any interest to the companies. Automatically, the development will be there. If they earn the profit, then only it will be available to the equity shareholders. So, in that case, without cost of capital, the capital is available to the companies, then it will give the development to the companies also. You have to see, in the year 2012, again the investment come down for the equity shares comparing to the previous years. The people, because they thought about the riskiness in the equity shares. Because of the recession, because of the various factors and various scams, the people, they lost their interest in making the investment in equity shares. They gone for the banking deposits. You have to see the bank deposit which is increased to 4,929 crores. So in that case, the people, they want to avoid the risk. That kind of mentality easily we can able to identify by the way of making its comparison. Okay. Okay. When we are trying to discuss the various factors about the macroeconomics, the another important one that we have to identify is inflation. And recently you people know that the country Zimbabwe affected a lot because of the inflation. There what happened, do you know that? Hyperinflation happened to the particular nation. Because of the hyperinflation, the people of Zimbabwe, they are not able to buy the products for less cost. They have to take bundle and bundle of money to buy a single cup of tea. What happened? The government is not able to stabilize the value of the money, and they started off printing the notes. Once they started off the printing the notes, the value of the raw materials, the value of any kind of product rose up. The entire nation collapsed because of this kind of activity. So the inflation is getting very important when we are analyzing the economic factors. And you have to say the inflation rate is also increasing. When the inflation rate is increasing, what is another problem there? We are not able to properly estimate the real development happening in a particular nation. The development is also there, the cost is also getting rise, means in that case, what is the people's earning, what is the real worthiness the companies got, that we are not able to identify. They have to spend more and more. So that will be the problem of the inflation. And you have to see, by July 2008, the inflation price index is 11%. That was the ever highest in the last 13 years to us. And previously, you may identify the inflation rate is only near around 4%, 6% like such. But in the year 2000, July only, which reached 11%. But what happened? The government is making measures, and nowadays, presently, which is near around 6%. Okay. You have to see, here also I made a comparison regarding the inflation rate over a period of time. In the year 2005 and 6, overall commodities inflation is only 4.3%. But what happened? You have to see in the year 2009 and 10, fuel and power increased to 11%, primary articles also. Primary articles stands for the commodities, groceries, like any kind of things, which is also rose up to 11%. Because of this thing, the overall inflation come down to 8 to 11%. And you have to see in the year 2012 and 13, presently the inflation resides at 8.7%. The cost is always increasing there, that you can able to identify. Okay, sir. What will be the drawback to the industries when the inflation is more? If the inflation is heavy, the companies, they have to pay more money for getting the raw materials, labors, or whatever the factors. In that case, the cost of manufacturing will be more. If the cost of manufacturing will be more, means they have to sell it for higher prices, until otherwise they have to lose the profit. Every time it is not possible to sell the product for higher prices. So in that case, the companies, they have to lose, or they have to give up some amount of profit. So it will be a loss to the company. So the development will get stagnant. If the development is not up to the expectation, what will happen? The investors will not get the returns. Once the investors are not getting the returns, they started off taking money from the company, particular company. So two aspects are there. One is the company is losing profit. By the way of losing the profit, they are not able to furthermore develop. Once the development is not there, stagnant is there, the people, those who invested, they will take out the money from the particular industry or the company. So in the two dimension, the inflation plays a vital role regarding that. So we have to identify the inflation and its factors also. And you have to see one another factor, I gave it to you. Especially in the Indian economic environment, you have to see the overall inflation, how it happened with the food, non-food, minerals, fuel and power and manufacturing. Especially the fuel and power and the food factors only had a huge inflation index. You have to see from the year 2008 onwards, the food factors are having heavy increase in the rate itself. In the same ways also, the fuel also, you have to see, the fuel also increased and the food factors also increased. But in the 2009, somewhat drop is there. Again, it started off increasing from the year 2010 onwards. from the year 2010, 2011, 2012, the inflation rate is always increasing. But comparing to the year 2010 or 2008, presently it is okay. Now we are residing in the 8% category. When we are discussing about the inflation, we have to discuss one another factor also. That is called as consumer price inflation. How a person will buy the product. Why we have to consider, sir? Even though industries are manufacturing, they have to sell majority of their product to the individual consumers. For example, electronic goods are there. Even though they are producing the electronic goods, they have to come for the low level people for selling their products, TV, refrigerator, like such kind of things. In that case, if the people are not able to buy the product for lower cost, what will happen? The sales will come down. You have to see, India is in a dangerous situation regarding the consumer price inflation. Especially in the year 2013, we may identify India is having near around 10.9% in the year 2000, February of this year, 10.9% of inflation rate, which is the dangerous second country among the world. The people, they have to pay more money regarding buying the products. Certainly it will affect the industrial development also. So not only we have to consider the entire nation inflation, we have to consider the consumer price inflation also. Okay. The another factor that we have to consider in the while analyzing the macroeconomic factor is interest rate. Okay, what is interest rate? Interest is the price we are paying for our capital. For example, we are going to bank for taking a loan. They will not provide the loan without any kind of cost, because they are also taking the money from somebody. For them also they have to pay. So in that case, the loan which are given for some cost. If the rate of interest is so high, the people will not go for buying or taking the loans and again and again. If the loan is available for lesser rate, the people will preferably take the loan and they will repay. The same thing is happening with the industries also. You have to see, if the cost of capital is high, means the people will not take the loan for further business development. If the cost of capital or the interest rate is low, the industries will take the loan confidently and they will do the developmental activities. And you have to see, the interest rate affect the cost of financing of firms, especially clearly stated given there. The interest rate which affects the cost of financing. What is cost of financing means? When I am taking a loan, or what is the repayment regarding that? All these things are getting affected because of the interest rate. And you have to see, the interest rate in India reached all-time high in the year 2000, August 2000, which rose to near around 14.5%. That was a drastic moment for the banking companies as well as to the industries. Whomever taken the loan from the bank, they have to pay near around 14.5% of interest regarding that. And what happened? It come down to 4.25% in the year 2009 only. Presently, if anybody is investing in the bank, they will get the interest only in between the 4 to 6%. Still the banking companies, they are giving such kind of things only. What happened? But over a period of comparison, if we made from the year 2000 to 2014 onwards, the overall interest rate is near around 6.6% only. So by the way of seeing this, what is happening? Comparing to any other states, comparing to any other nation, the cost of capital is somewhat less in India. The companies, they are enjoying the loan or capital in less interest. And you have to see, here I projected a trend of interest rate, how it happened from the year 2003 to through 2010. Especially three things are there. One is repo rate, reverse repo rate, and banking's interest rate, deposit rate. Based on these three things only, the interest rate for the loans are getting determined. Repo rate means which is given by the RBI to the banks for their deposits. Reverse repo rate means the banks, whatever they are repaying for the loan taken from the RBI, and banking rates, you know that whatever the deposits happening with the banking. So all these things are determining the interest rate. You have to see, the banking interest rate always resides the same, which is near around 4 point something, like such kind of category. But repo rate and reverse repo rate is always having fluctuation. Because of the monetary policy and physical policy, the repo rate is getting determined. If the government want to make more available of money in the nation, means they will reduce the interest rate, repo rate interest, and they will increase the reverse repo rate. What is happening? Automatically money flow will be available in the nation. If they want to control the money flow, they will increase the repo rate and they will reduce the reverse repo rate. Automatically every bank they will deposit with the RBI. So automatically these things are happening. So these three things will determine the interest rate. If the interest rate is lessly available, the development is there with the industry. If the interest rate is highly is there, then automatically it will affect the development of the industry in the nation. And another important factor that we have to identify is budget and tax structure of the nation. Every year by February 28th, the entire nation focusing on a particular person, the finance minister of the India. The entire people, they are waiting for the 2-hour speech or 3-hour speech by the finance minister, because in the particular speech he is going to make enormous number of announcement what the nation is going to face or what the nation is going to get, or what are the sanctions or what are the levies are there. All the information will be available in his budget proposal speech. And you have to see, based on the budget only, the industrial development is also there, the economic development is also there. I want to give one example to you. In the last year budget, Arun Jaitley, he made a statement regarding, or he gave a sanctions regarding the electronics industry. The import levies are reduced, especially for the LED TVs, screens or whatever the basic instruments available there in the LED TVs. Because of that, what happened? Recently, you may identify the companies like Micromax. They started off producing LED TVs and selling the LED TVs for less cost. If you want to buy a LED TV in the size of 50 inches TV, if you go to the showrooms like Sony or LG, which cost near around 1,50,000 to 3 lakhs. But these Micromax people, they are able to give for 50,000 to 60,000. How it is possible means, because the government removed the levies or they reduced the levies for the import of such kind of instruments. Because of the less cost product available, or the product is available for less cost, the people are able to manufacture and they are able to sell for the low cost. So the budget is very important one regarding estimating the development of the nation, development of the economic environment. You have to see, it's an elaborate account of the year's revenues and expenditure, how it is going to happen. And one other important thing is also there. There are two different budgets are always available. One is a deficit budget, another one is surplus. What is the deficit budget and surplus budget? If the expenses are more than the revenues, that budget is called as deficit budget. And the revenues are more than the surplus, the revenues are more than the expenditure, that particular budget is called as surplus budget. Okay. If the deficit budget is happening in a year, how it will affect the environment? Or if the surplus budget is there, how it will develop the economic environment? You may see this. A deficit budget may lead a high rate of inflation and adversely affect the cost of production. That you have to see. Because the government even not having the money in that case, they will look for more money and they will make the levies. Automatically what will happen? It will affect the cost of production. Inflation rate will be there. Okay, if the surplus budget is there, then automatically it will be so favorable for the stock market. Everybody is having the money, automatically investment will be there. So such kind of things easily possible there. And you have to see, by this thing I will conclude. You have to see, especially the budget, you may see what are the benefits or subsidies available there. In the year, financial year 2014, overall subsidy happened with the various, every year, the budget is not only mentioning the revenues and expenditure of the nation, which is expressing the overall subsidies, what is going to be provided there, what are the sanctions are there, what kind of tax holidays are announced to various industries, and what are the new avenues open there, where the free economic zones are going to be fixed. All the informations are available there. So budget will be a key for furthermore development in the coming years to the particular economic environment. So in that case, we have to lot of things, we have to know about lot of things about the budget of a particular economic environment. So in the coming classes, we have to discuss a lot about what is the budget and what are the announcements came from the government regarding, especially related to India, and to the various industries that we will discuss in the next class. The budget is not only presenting the revenues and expenditure of every year, which is also giving the information about what are the industries are getting sanctions, which industries are having new levies or tax holidays, plus where the free economic zones are going to be, then what are the new avenues are getting opened. These kind of informations are available with the budget. We will discuss about the budget in an elaborate manner by the next class.